What is up, everyone? Welcome to my channel, The Hobbyist Economist. My goal is to educate you on consumer economics and finances so you can make better decisions financially. So today I want to talk about home prices. If you do a Google search or a YouTube search, the last few years there's been so many people that have been calling for a home prices to crash, and for no other reason than seeing interest rates skyrocketing. But there's more to it than that. There's reasons why home prices go up, and there's reasons why home prices come down. And I'm hopefully going to uncover some of that so that you can make your own decision as to what you think is going to happen in 2024. And of course, I'm going to give you my personal thoughts as well. First thing we have to think about with real estate, it's not like stocks. Equity markets, there's buyers and sellers every second of the day. In real estate, things take a while to transact. Think about it this way. The equity market is like a speedboat, like curving around the water. It could go right or left pretty quickly. It could stop or accelerate pretty quickly. The real estate market is like a large cruise ship. In order for it to slow down, it takes a long period of time. There's a lot of ground or water that has to be covered for that to actually stop. And in order for it to reverse and go backwards, it takes a long time as well. The captain of the ship, before taking a turn, has to predetermine when they're going to turn because it takes so long for it to turn. So looking for an immediate turn in real estate, it doesn't happen that quickly at all. So we have to really kind of be conscientious of that. Now, I get asked all the time, are home prices expensive right now? And that's kind of a loaded question. Back in 2020, and I'll link a video below, I kind of gave my thoughts as to where home prices were going at that time. And history has proven me to be mostly correct on it. So you could check out the video below to check that out. But in terms of what goes into home prices, there's a lot of different variables. And I'm not going to cover everything, but I'm going to cover the biggest one I believe drives home prices. And that is people's income. Right? If people are making more money, they could afford more expensive things. I remember in economics, I had a professor who dumbed down how prices move and why they move. And he said pretty simply, when there's too many dollars facing too fewer goods, prices go up. When there are too many goods and many fewer dollars chasing them, prices go down. Why? People have to, that retailer has to move that product. If there's no buyers, they have to create the demand. How do they create the demand? They lower the price, right? In real estate, things work kind of similarly. If there's a lot of properties on the market and very few buyers, sellers have to start cutting prices in order to motivate buyers, right? If there's a tremendous amount of buyers and very few properties on the market, then sellers have all the power, right? Buyers have to bid up and go against other buyers in order to secure a property. And that's what we've seen in our Connecticut real estate market for the past 3 years plus, right? We have sellers markets and we have buyers markets. And we've had what we just had, an extreme sellers market, right? Where sellers had 10, 15, sometimes 20 plus offers, and they weren't only going after what offer was the highest. They were choosing it based on the type of financing that someone had, cash versus 20% down versus 30% down. And they were also asking buyers to waive mortgage contingencies so that in the event they can't get a mortgage, they still have to provide the secure deposit to the seller, asking them to waive inspections, waive appraisal contingencies. Kind of crazy, like things that don't happen in any sort of normal markets were happening in the last 3 years, and in some cases still are in Fairfield County. So now, let's take a look at a little bit of data. In economics, data is everything. We take a look at what's happened in the past, and we try to figure out what we think is going to happen in the future. So let's go back to the question, is real estate expensive right now? And how do we determine that? Often I've heard and been told, and I agree with this, that a price of a home should be anywhere from 3 to 5 times somebody's income. The closer to 3 times somebody's income it is, the more affordable the property is. The higher in proportion to somebody's income the property is, the more expensive the property. So let's take the United States and take a look at it as a whole, right? And let's pull up a graph from the Philadelphia Fed, and we're going to look at household median income, right? Not our area is a little different, but let's just take a look at everything as a whole. Right? If we take a look at this graph, it goes from pre-85 all the way through the end of 2022. There's a little bit of 2023 in there, but they're not kind of done with that data. And let's take a look at 2015, because if you look at this graph, 2015 is where income started really taking a large increase towards the upside, right? So if we look at 2015, the U.S. household median income was about $67,000, right? Now, if we take that and multiply it by 3, that's about $201,000 a year. Multiply it by 4, that's $268,000 a year. Multiply it by 5, that's $335,000, right? In terms of the multiple of income, not per year, but the multiple of income. So now let's pull up a different graph, right? Same period of time, and let's take a look at the median sales price for the United States. Let's take a look at 2015. If we look at 2015, the median sales price at that time was around $295,000 a year. So we're not quite at the level of true expensive-ness, but we're not really far from that, right? So let's fast forward now to 2020. We saw a pretty large increase in median income in that 5-year period of time. It went all the way up to $77,000. On a percentage base, that's pretty large according to historical measures. So 3 times the income, we're at $231,000. 4 times the income, $308,000, and then 5 times, $385,000. 2020, the median sales price was $320,000, a lot closer to 4 times the median income level. So in comparison to 2015, real estate at the beginning of 2020 was more affordable than 5 years previous. So we actually had a little catch-up room for it to feel expensive again, right? So now fast forward to 2023, we are past the 5 times level. So real estate is technically a little expensive. We combined that with interest rates really just tripling, almost quadrupling in a very short period of time. And real estate does feel expensive at the moment. It really does feel expensive. And it may be, but how do we know what's going to happen in the future, right? We have a little bit of data here. So let's try and forecast what interest rates are going to do, right? So I'm going to pull up right here the chart of the 30-year fixed rate going from like kind of the mid-80s through today. For a long period of time, the 30-year fixed rate was declining, right? We had almost a 4-decade period of time where mortgage rates were just trending lower. So if mortgage rates are trending lower, that means the mortgage payment for a household is lower, right? So you could actually have a larger portion of your household income going towards a overall purchase price, but if the mortgage rates are in the 3s or in the 4s, the percentage of your income going towards the mortgage payment tends to be lower. So the lower rates go, it helps home prices stay a little bit more lofty, right? It just makes sense, correct? Now, when the Feds were trying to slow down inflation, and we're going to pull up a chart right now of the prime rate. This is the rate that the Feds directly influence. And we're going all the way back to the 50s, just because it's going to illustrate to you a bigger picture of what's really going on in a historical perspective. And we're going to see that, come the 80s, when Volcker was head of the Fed and was trying to crush inflation at that point, he jacked up interest rates all the way into the 20% levels, right? Nowhere near where we are today. And once he defeated inflation, bonds improved. Feds had to cut rates to stimulate the economy again. And this is the cycle. If you look at this, it's a perfect cycle. Feds increase rates, right? And if you look at the shaded areas, that's where we have like a mini recession or a large recession. They increase rates followed by a recession, right? And then rates come down. They increase rates followed by a slowdown in the economy, then rates come down. So the Feds are trying to create demand or eliminate demand. Powell, when he started raising rates in 2020, he said in his policy statement, we are trying to exercise demand destruction, right? They're trying to make things so expensive that we as a consumer will think about it like, hey, should I really buy a new house? Should I buy a new car? Should I actually go on vacation because my credit card's interest rates are so high? He's trying to slow down consumer spending. He's trying to make things more expensive for businesses so they stop giving people wage increases. And he's trying to rein in inflation. And I think he's done a really good job of that so far without derailing our economy. And I think that's about to change. I think the Feds are at the end of their hike cycle. And why do I think that? A, we've seen a lot of things roll over. Inflation is starting to come down. Employment is starting to weaken. In fact, if you take a look back at the chart with U.S. household income, we've already started to see income levels roll over, right? And if we look at this chart in comparison to the Fed funds chart, you'll notice that whenever income starts rolling over, the Fed's not too far after that start cutting rates, right? Because that means that businesses have ceased giving raises, they ceased hiring, the economy is slowing down, so what do the Feds have to do? Cut rates in order to stimulate the economy again, right? So if the Fed is near the top of their cycle, and another reason why I believe that's true is that if you take a look at the chart of the Fed funds rate, most Fed hike cycles last about 2 years or less. This March of 2024, we are at the 2-year level, and we have not ever seen as aggressive of a pace of increases as we have seen since the late 70s, early 90s. And during that period of time, from March of 77 through March of 1980, that was the longest hike cycle the Feds have ever gone through. And they were really trying to rein in inflation tremendously at that point. We're nowhere near that level at the moment, right? So let's hypothesize a little bit. The last 3 years, especially here in Connecticut, we have not seen home prices really come down. If anything, they've stalled out. This is in the face of interest rates moving higher and higher. We went from 3% to over 8%. Now we're back down a bit from there. Now, we don't have that much inventory, right? And what will create inventory right now? Will somebody with a 3% mortgage rate want to list their house? Probably not. Right? Will a builder with this level of uncertainty about the future and with building costs being as high as they are, will they want to build a house? No. In fact, building permits have had a steep decline. A lot of builders are waiting to see what happens with the Fed policy. They're waiting for rates to come down before they'll start actively building as much as they did before, because they know lower interest rates is going to help move the inventory. And it takes a builder a good amount of time to go through the permit process, build a home, market the home, and put it on the market. So that will take probably a year to 2 years for them to create that level of inventory. Right? Let's talk about foreclosures. They've been almost non-existent. They're starting to hit the market right now. But in the state of Connecticut, it takes typically a year and a half to 2 years of a consumer not making monthly payments before the foreclosure process is done. And quite frankly, banks don't want the foreclosures. They're willing to work with the borrower in order to keep them in the house. So it could take even longer before we see a big level of inventory hit the market. And why would somebody want to foreclose right now? Home prices are higher. In the last 3 years, anyone who bought a house has to put a big down payment for them to actually get their offer secured. So most properties in Fairfield County and most of Connecticut have a lot of equity built into them, right? In the last 3 years, home prices have gone up. They put down money on the house. They have a lot of equity. So there's not really motivation for somebody to default on the property. They'll just sell the house, right, and walk away. So we're not going to have that level of distressed sales where there is an asset manager at the bank that's overwhelmed with properties that they're just trying to get them off the books because of the carrying costs associated with them. It's not 2009, 2010 again. That's not happening right now. And we're not going to see foreclosure inventory hit the market for quite some time. It'll take a while. It will happen. We're going from almost a level of zero foreclosure on the marketplace. If it goes up to 1%, we're still below trend. That's way below what the normal market holds in terms of foreclosure activity. So if we're in a point of time where rates are going to start rolling over, those buyers who maybe sidelined themselves see rates come down, their monthly payments that they're going to have is going to be a little lower, they may get back into the marketplace, right? If there's fewer properties for sale due to a lack of motivation for most people to want to sell their home because of their low interest rates, they're going to stay put. So there's not going to be that level of inventory in the marketplace. So going back to what my the economic professor said, too many dollars facing too fewer goods, prices go up, right? We don't need to see prices go up, Real estate's real estate. It's a cruise ship, right? It's slow. We could just see prices stay stagnant for a while before they make a decision to go up or down. If the economy improves before that time, or if rates really make a large move lower, like say get back into the mid 5s, maybe mid 4s, that's going to be great, right? We're going to see bidding wars happen all over the place because everyone's used to higher interest rates. It's going to feel like real estate's on sale. Like my monthly payment just went down $600 versus me buying a house a year ago. So it's logical that home prices may stay level for a portion of next year, but if we see rates come down, we can see home prices go up a little bit. If you look at it different ways, if we do get those foreclosures, right? If people can't afford their mortgage payments because they lost their jobs or they're making less money, we may see a little bit more inventory hit the market, but we're at such depressed levels, we'll just get back to a normal environment, which means home prices could probably stall out. If they go down, it may be a normal, healthy adjustment, 5% down, 4% down. I just don't see a crash scenario here, right? I took a look at the data. I'm talking to people every day who are looking to purchase a house. I'm talking to agents who are very, very, very heavily involved in real estate transactions in my marketplace. And not one person can see a scenario where real estate just crashes. And there's science for that, right? There's signs that we can see early on to tell us if real estate prices are going to crash. And unless rates go to 10%, 11%, 12%, which I see it as being very unlikely, then that's not going to happen. In fact, over in Europe, the central bankers there are already starting to talk about cutting rates, and some countries they already started cutting rates. There was a globalized effort to raise rates because everywhere after COVID, prices went up crazy. So every central banker was trying to raise rates, and some countries are already starting to cut rates because their economies have slowed down so much. And I think we're going to follow suit. And if that happens, and if mortgage rates decline, real estate's going to stay healthy. There's just not really much motivation to, in my opinion, have rates go down. And sorry if I'm repeating myself, but I'm just trying to drive that point home. So let me know in your thoughts, comments below, what you think. My next video, I'm gonna explain why home prices went up so much during COVID, and it's not just because interest rates went down. There's more to it than that, which I think will help you understand the dynamics behind what moves home prices a little bit more. And if you like this video, please subscribe, ring that bell. I'm going to try and get content out as much as possible and make sure it's relevant and good content. Thank you all so much.